There's something I discovered in the Epstein documents that you need to hear. What I'm about to reveal isn't conjecture or theoretical speculation. This is an authentic correspondence from an actual individual transmitted to Jeffrey Epstein on a verified date with genuine attachments, concealed within millions of document pages released by the United States Department of Justice. And it concerns silver. Let me provide the background first because the timing is remarkable. In November 2025, the Epstein Files Transparency Act became law. It mandated the DOJ to disclose all unclassified records connected to Epstein and Ghislaine Maxwell. Since January 2026, the DOJ has published over 3.5 million pages. 3.5 million. That encompasses correspondence, financial statements, wire transaction records, FBI interview documentation, flight manifests, and investment statements. The global community has concentrated on the political figures in these files. Presidents, royalty, billionaires, technology titans, and understandably so. But while everyone searched for celebrity names, I examined the financial documentation because that's my focus. I traced the capital. And what I uncovered in those financial records stunned me. I've been analyzing the silver marketplace for weeks now. Vault depletion, supply chain conflicts, leverage liquidations, the complete scenario. But when I encountered this document, I had to halt everything because this correspondence sent in May 2011 contains a silver compression hypothesis so accurate, so exact, and so eerily prophetic of what's occurring right now in 2026 that it gave me chills. And adjacent to that correspondence, there's a JP Morgan investment statement revealing that Ghislaine Maxwell, the woman presently incarcerated for trafficking offenses, was purchasing millions of shares of a silver extraction corporation at precisely the same moment. Welcome to our channel. Subscribe if this is your initial visit. I examine what traditional financial journalism refuses to address. Also, indicate in the comments where you're viewing this from because I need to gauge how many of you are monitoring the files as intently as I am. If you've been following this analysis, you understand I don't make assertions without evidence. Everything I present is verifiable. Everything is documented. And today is identical. So let me demonstrate exactly what I discovered. The correspondence is dated May 27, 2011. It was transmitted by a man named Bernard to an address associated with Jeffrey Epstein. The subject line states Power of Attorney Silver Centrope. Already that subject line alone should give you pause. Power of Attorney Silver Centrope in one sentence. This isn't casual correspondence between acquaintances. This is a financial administrator communicating with his client about account administration and investment approach. Bernard informs Jeffrey that he's departing his position at a Swiss private institution called Artis. This isn't a standard institution. This is the type of institution that administers capital for individuals whose net worth begins at 9 figures. He needs Jeffrey to authorize a power of attorney on something called financial trust before month's end, so Bernard can continue administering the account. In other words, this man is so integrated in Epstein's financial existence that even when he transitions employment, the first action he takes is ensuring he can continue controlling the capital. That's the connection. Now pay attention to what follows. Bernard writes, and I quote, "I have also enclosed some research I made on the silver market, and I am fully convinced that a squeeze is possible if one can take delivery of 100% of the futures contract." Let me repeat that. A squeeze is possible if one can take delivery of 100% of the futures contract. In 2011, a financial consultant to Jeffrey Epstein is composing a detailed hypothesis about how to compress the silver marketplace by taking physical delivery of all the futures contracts on COMEX. And he's not speculating. He enclosed research. The correspondence had attachments, a silver executive summary document, a CME position limits PDF, research on silver corporations. This wasn't a casual reference. This was a structured investment hypothesis being presented to one of the most connected financial operators in contemporary history. But it deepens. Bernard continues. He writes that the squeeze caused by the 5 increases in margin requirements only squeezed the weak hands. Stop right there. If you watched my analysis on the silver crash, you understand exactly what this signifies. In 2011, silver ran from around $17 to almost $50. Then the CME raised margin requirements 5 times. 5 times, and the price crashed. Sound familiar? Because in 2026, silver ran from 37 to 121. And what occurred? Margins got raised from 5% to 8 to 11 to 15 to 18%, and the price crashed to 64. The exact same strategy 14 years apart, and Bernard identified it in real time in 2011. He called it what it was, a flush of the weak hands, not a fundamental change, a mechanical liquidation. Then he makes his projections. He says silver without undue speculation will end the year at $60. He says the inflation-adjusted value is $150. And he says the gold to silver ratio will fall from 40 to under 20 within 36 months. I need to pause here and explain why these figures matter. Because if you're new to silver, you might not comprehend how radical these projections were in 2011. Silver had just crashed from $50 to 30 taus. Every analyst on Wall Street was declaring the silver bubble had burst. Every headline was calling silver investors delusional. The mainstream narrative was that silver would return to $15 and remain there. And amidst all that noise, this man is writing to Jeffrey Epstein stating the inflation-adjusted value is $150. He wasn't following the crowd. He was analyzing the fundamentals, the supply deficit, the industrial demand, the monetary properties, the futures market mechanics, and he reached a conclusion that was the exact opposite of consensus. That requires either extreme conviction or extreme intelligence, or both. Now let me contextualize these projections for 2026. Silver is currently trading at $82. Bernard's $60 target in 2011 was dismissed by the mainstream, but his inflation-adjusted value of $150. Adjust that for 14 more years of inflation from 2011 to 2026. You're examining well over $200 in today's terms. And his gold to silver ratio prediction, in 2011 it was at 40. Right now in 2026, with gold above 3,000 and silver at 82, the ratio is around 37. It has been compressing exactly as he predicted, just on a longer timeline. This man wasn't incorrect. He was premature. And in markets, being premature and being incorrect look identical until suddenly they don't. 14 years later, the marketplace is proving him correct. Now here's where the narrative becomes truly disturbing, and I mean disturbing in a manner that connects Epstein's financial world directly to the silver marketplace in a way nobody has explored publicly. Alongside this correspondence, there is a J.P. Morgan Chase investment statement. The account holder is Ghislaine Maxwell. The document is marked confidential treatment requested by J.P. Morgan Chase. It was never intended to be seen by the public, but here it is, released by the Department of Justice for anyone to examine. The document covers December 2010, which is just 5 months before Bernard's silver squeeze correspondence to Epstein. And what does it reveal? It reveals that Ghislaine Maxwell purchased shares of First Majestic Silver Corp through her J.P. Morgan account. First Majestic isn't some random corporation. It is one of the world's premier pure-play silver extraction corporations listed on the New York Stock Exchange. In 2026, its share price is up over 130% since January. Ghislaine Maxwell was buying it 15 years ago, not a small amount. On November 29, 2010, she bought 100,000 shares. Then on December 6th, she bought 3 million shares, 3 million shares through J.P. Morgan. The total cost on the statement shows approximately $41,000 in the same time period that Epstein's financial consultant was preparing a silver squeeze hypothesis and attaching CME position limit documents. Let me ensure you comprehend the web I'm showing you. Epstein's financial consultant writes a detailed plan about how a silver squeeze is possible through physical delivery. Ghislaine Maxwell is simultaneously buying millions of shares of a pure-play silver extraction corporation through an account at J.P. Morgan. And J.P. Morgan, the very institution holding Maxwell's account, would later be caught manipulating precious metals markets and pay a $920 million fine in 2020. Let me tell you what they were actually doing, because it connects directly to everything in that correspondence. J.P. Morgan traders were convicted of spoofing. Spoofing means placing thousands of fake buy or sell orders that you never intend to execute. The purpose is to deceive other traders into thinking there is massive demand or supply, which moves the price in the direction you want. Then you cancel the fake orders and profit from the price movement you created. J.P. Morgan did this in gold and silver markets for over 8 years. 8 years. Multiple traders were personally convicted and sent to prison. The head of J.P. Morgan's precious metals desk was found guilty of racketeering, not securities fraud. Racketeering, the same charge they use against organized crime. So, here's the picture. And I want you to really sit with this for a moment, because this is the type of thing that sounds like fiction, but it's documented in federal court records. Epstein's network is discussing a silver squeeze based on physical delivery. Maxwell is buying silver extraction stocks through J.P. Morgan, and J.P. Morgan is simultaneously manipulating silver prices through spoofing to keep them suppressed. If you wanted to accumulate a massive position in silver before a squeeze, what would be the ideal scenario? You would want someone suppressing the price while you buy. You would want the price artificially low so you can accumulate as much as possible before the squeeze executes. That's exactly the dynamic these documents reveal, whether it was coordinated or coincidental. I'm not stating these things are directly connected. I'm stating that the convergence is extraordinary. And I'm stating that nobody in mainstream financial journalism is covering this angle, because the Epstein files are so massive, so dense, and so overwhelming that the financial connections are being buried under the political names that generate headlines. Now, let me explain why this matters for you right now in 2026, because this isn't just a history lesson. The hypothesis in that correspondence, the silver squeeze hypothesis, is more valid today than it was when it was written. Bernard's core argument was simple. If someone takes physical delivery of 100% of the futures contracts, the marketplace squeezes. In 2011, COMEX had enough inventory to cover the contracts. In 2026, that's no longer the case. COMEX registered silver inventory has been in a staircase decline for years. Shanghai vaults have collapsed from 1,165 million kilodue to 350,000. London lease rates are at 4.5%, which signals extreme physical stress. The marketplace is in backwardation, meaning buyers are paying a premium for immediate delivery over future delivery. Every single condition that Bernard described as necessary for a squeeze is now present, not partially, not theoretically, actually present in the data right now. And this is the part that should terrify anyone who is short silver or sitting on the sidelines, because I went through Bernard's hypothesis point by point and checked it against 2026 data. His squeeze requires physical delivery. COMEX delivery notices are surging right now. Large buyers are standing for delivery instead of rolling contracts. His hypothesis says margin hikes only flush weak hands. We just watched it happen. 121 to 64. 39,000 contracts wiped, but lease rates went up during the crash and backwardation got deeper. The weak hands are gone, but the physical marketplace is tighter than ever. His hypothesis depends on a supply deficit. In 2011, it was a small deficit. In 2026, we're in the 5th consecutive year of deficit, and it's growing. Solar demand has doubled. Electric vehicles, 5G, AI data centers. None of these demand categories even existed in 2011, and his inflation-adjusted value of 150. Adjust that for 14 more years of inflation. You get $220 to $240. Silver is at 82. If his analysis was correct, and the directional prediction has been dead right so far, silver is trading at roughly 1/3 of fair value right now. In 2011, the squeeze failed because the exchanges raised margins 5 times and flushed out leveraged speculators. The weak hands got wiped, but Bernard recognized that the fundamentals didn't change. The supply deficit didn't change. The industrial demand didn't change. Only the leveraged speculative positions changed. And he was correct, because here we are 14 years later and silver is higher than his $60 target. The fundamentals won. They just took longer than anyone expected. And here's what makes 2026 different from 2011. In 2011, the buyers trying to squeeze silver were retail traders and small funds. They could be flushed by margin increases. In 2026, the buyers are nation states. China is implementing export controls on silver. The United States has classified silver as a critical mineral. Both superpowers are racing to secure physical supply from Latin America. Sovereign buyers don't get margin called. Sovereign buyers don't care about short-term price volatility. Sovereign buyers take delivery, which is exactly what Bernard told Epstein was the key to the squeeze. Take delivery of 100% of the futures. The mechanism Bernard described in 2011 is now being executed not by retail traders, but by the most powerful governments on earth, and they're not doing it to make a trade. They're doing it because silver is a strategic resource that's critical to solar panels, electric vehicles, semiconductors, military technology, 5G infrastructure, and medical equipment. The demand is structural, the supply is declining, and the players are no longer weak hands that can be flushed by margin calls. And here's something that's remarkable. And if you were online in January 2021, this is going to resonate. In January 2021, 10 years after Bernard wrote that correspondence, the Reddit community, Wall Street Bets, attempted a silver squeeze. They called it the silver squeeze. Millions of retail traders tried to buy physical silver and silver ETFs to force a short squeeze on COMEX. The movement trended worldwide. Silver briefly spiked to $30, but it failed. Why? Because retail traders were buying paper silver through ETFs, not taking physical delivery, the exchanges raised margins again, and the weak hands got flushed again. The exact same pattern as 2011. But here's what nobody noticed. Bernard's correspondence said, the squeeze requires taking delivery of 100% of the futures contracts. The Wall Street Bets crowd was buying SLV, which is a paper ETF. They weren't taking delivery. They did the opposite of what the hypothesis required. They tried to squeeze silver the wrong way. The information about how to actually do it was sitting in Epstein's correspondence the entire time, and nobody had read it yet because the files hadn't been released. Now in 2026, the buyers aren't making that mistake. China is taking physical delivery. The United States is stockpiling through Latin American supply chains. Central banks are accumulating. Everyone has learned the lesson that Bernard articulated 15 years ago. Physical delivery is the weapon. Paper is the distraction. And here's one more detail that will surprise you. In 2011, the year Bernard wrote that correspondence, J.P. Morgan held 0 ounces of physical silver. 0. By 2017, just 6 years later, J.P. Morgan had accumulated over 133 million ounces of physical silver, more than the Hunt brothers held when they tried to corner the silver marketplace in 1980. The Hunt brothers owned so much silver that the government had to intervene. Silver went from $6 to over $50 during their squeeze, and J.P. Morgan quietly accumulated even more than that. The same institution that was spoofing silver prices downward was simultaneously accumulating the largest physical silver position in modern history. They were suppressing the price with one hand and buying with the other. Now, here's why this matters beyond the Epstein headline. Because the real insight isn't about one correspondence or one person. It's about what that correspondence reveals about how the ultra-wealthy think about assets. When a private banker to one of the most connected financiers in history writes a detailed silver squeeze hypothesis and attaches CME position limit documents, that tells you something critical. The top of the financial hierarchy wasn't dismissing silver as a pet rock. They were studying the exact mechanics of how to corner the marketplace through physical delivery. And they identified the same hypothesis that's now being executed by sovereign nations 14 years later. That's not a coincidence. That's a playbook. And you just got to read it freely because the DOJ released it. The Epstein files aren't just about criminal activity. They're a blueprint. And what the blueprint says is clear. Physical delivery is the weapon. Supply deficit is the fuel. And the only thing that ever stopped the squeeze was flushing weak hands through margin manipulation. The weak hands are gone now. I demonstrated that previously. Open interest on COMEX collapsed from 176,000 contracts to 137,000. The leveraged speculators have been wiped out. What remains is strong capital, patient capital, sovereign capital, the type of capital that takes delivery and doesn't sell. Let me connect all the elements for you because if you're still watching, what I'm about to present is staggering when you see it all at once. In 2011, Epstein's financial consultant identified the exact mechanism for a silver squeeze. Take physical delivery. In 2010 through 2011, Ghislaine Maxwell was buying millions of shares of silver extraction stocks through JP Morgan. In 2020, JP Morgan paid $920 million for manipulating precious metals markets through spoofing. In 2023, JP Morgan settled for $75 million specifically for their banking relationship with Epstein. In 2025, the United States classified silver as a critical mineral. In 2026, China implemented export controls on silver. Right now, COMEX and Shanghai vaults are draining. Lease rates are at historic levels. The marketplace is in extreme backwardation, and silver sits at $82. While the inflation-adjusted value that Bernard calculated in 2011 translates to over $200 today, every piece of this puzzle was visible in that single correspondence from 2011. The mechanism, the target, the conditions. And now, 14 years later, every condition has been met, and the players are infinitely more powerful than the retail traders who tried and failed in 2011. I want to be careful here. I don't know if Epstein personally traded silver based on this correspondence. I don't know the full extent of Bernard's relationship with Epstein's financial operations. I don't know if the Maxwell share purchases were coordinated with the squeeze hypothesis or coincidental. What I do know is that these documents exist. They're in the public record. They were released by the Department of Justice, and they demonstrate that the silver squeeze hypothesis was being discussed and acted upon at the highest levels of private wealth management as early as 2010 and 2011. Here's what I think this means for anyone holding silver right now. The hypothesis hasn't changed. It has only gotten stronger. The mechanism is the same. Physical delivery, the fundamentals are the same. Supply deficit, the pattern is the same. Weak hands get flushed, then strong hands accumulate. The only thing that has changed is the scale. In 2011, it was private wealth. In 2026, it's sovereign wealth. In 2011, the squeeze failed because margin hikes flushed the speculators. In 2026, the buyers are governments that don't get margin called. I hold silver. I hold extraction stocks. I have involvement in this situation. And the reason I hold them isn't because of correspondence from the Epstein files. It's because the data, the inventory figures, the lease rates, the backwardation, the government actions, and yes, the historical evidence that the smartest capital in the world has been examining this trade for over a decade all point in the same direction. If you've watched my entire analysis, you now have the most comprehensive picture available anywhere online. Part 1 showed you the vaults draining. Part 2 showed you the $300 price target. Part 3 showed you why the crash was a trap. Part 4 showed you the US-China supply chain conflict, and this segment showed you that the silver squeeze hypothesis isn't new. It has been circulating at the highest levels of global finance since at least 2011. The only difference is that now the conditions to execute it are actually here. Search Epstein files silver, read the correspondence yourself, look at the Maxwell investment statement yourself, verify everything I just told you. I'm not asking you to trust me. I'm asking you to examine the documents. The correspondence reference number is FA11655353. The JP Morgan statement reference is FA01520542. These are publicly searchable in the DOJ Epstein library. Go look, screenshot them, save them, because this is the type of thing that gets forgotten when the news cycle moves on to the next celebrity name in the files. And while you're there, ask yourself one question. If the people in Epstein's financial orbit, the private bankers, the wealth managers, the ultra-high net worth networks, if they were analyzing a silver squeeze in 2011 based on physical delivery mechanics, what do you think they're doing now in 2026 when every condition they identified has been met? When nation-states are executing the exact playbook they described, when the weak hands have been flushed exactly as they predicted? When the inventory figures are worse than anything they could have imagined in 2011, when JP Morgan itself accumulated 133 million ounces of the very metal they were manipulating. The smart capital saw this coming. They just saw it early. And now the rest of the world is catching up slowly, painfully, but inevitably. Share your thoughts in the comments. Send this to someone who thinks the Epstein files are only about politics. They're about capital. They're about metals. And they're about a hypothesis that's playing out right in front of our eyes. This narrative isn't over. It's accelerating. And the Epstein files just gave us the blueprint that shows the smartest capital in the world has known this for 15 years. The question is, what are you going to do with that information now that you have it too? This is the concealed financial system. I'll see you next time.